Hi there, my name is Frankie. Welcome to FAQ Show. Today, we are talking about why your oil and gas prices and investments might be on a roller coaster ride right now. Earlier in 2025, oil prices were actually dropping. A big relief for all of us. In fact, by April, crude oil hit a 4-year low. Cheaper oil meant cheaper gas and shipping costs, which helped cool off inflation around the world. Many countries saw price pressures ease, and central bankers started feeling hopeful. But then, plot twist. A sudden conflict flared up between Israel and Iran, and oil prices shot right back up from $60 over to $70 over in a flash. This month, US oil spiked past $72 per barrel after fighting broke out, and Brent crude jumped from about $69 to $74 literally overnight. Although oil prices have come down somewhat thanks to the ceasefire deal between the two countries, still a lot of damage is done, especially to those who trade crude oil futures or trade oil and gas stocks. Today, we'll explain what's going on in simple terms, why a clash in the Middle East is making oil pricier and inflation nervously creep up again, and how it's impacting global markets and your investment. Stick around because by the end of this video, you'll be able to talk confidently about this wild situation and even know a few tips on protecting your money during volatile times. Let's dive in. Why does a clash between Israel and Iran, two countries, send global oil prices into overdrive? It's not that either country controls all the oil in the world, but their situation hits a nerve in the global energy system. Let me break it down so that you can understand what's going on. Firstly, Iran is a significant oil producer, about 3.3 million barrels of oil per day, and exports roughly half of that. That's not huge, less than 2% of the world demand, but it's enough that if Iran's oil stops flowing, certain countries like China or others who buy from Iran would scramble to find replacements. More importantly, Iran sits next to one of the world's most important oil highways, the Strait of Hormuz. Think of the Strait of Hormuz like a narrow shipping lane that a huge chunk of the world's oil has to squeeze through. In fact, about 20% of all global oil consumption, roughly 20 million barrels per day, passes through that strait. It's a choke point, a narrow place that tankers full of oil must transit from the Persian Gulf to the open ocean. If something happens there, say conflict causes the strait to be closed, it's like blocking a major highway at rush hour. Oil shipments could be stuck and the whole world might face a supply crunch. Now, when Israel and Iran starts bombing each other, traders immediately worry. Will this war disrupt oil supplies? Even if neither Israel nor Iran is the top oil exporter, a war could spill over to affect nearby oil-rich countries or the vital shipping routes. Iran has in the past hinted it could block Hormuz if threatened, which would cut off not just Iranian oil but also oils from places like Saudi Arabia, Iraq and Kuwait that also ship through this strait. That fear alone is enough to send prices higher even if nothing has been blocked yet. Analysts say there's now a security premium of about $10 on each barrel of oil, basically an extra cost due to war fears. Markets are nervous that the conflict might escalate and someone might light a match in the oil supply chain. For example, during the current clashes, Israel struck some of Iran's oil facilities and a major gas field. And there was even a tanker collision near Hormuz amid the chaos. All this highlights how fragile the smooth flow of oil can be when missiles are flying around. In short, tensions in the Middle East equals jittery oil markets. Israel-Iran tensions hit a key nerve because Iran's role in OPEC and the geography of oil transport. Think of the global oil market as a bathtub. Even if one faucet like Iran isn't the biggest, blocking it or the drain like Hormuz can make water rush out and spill. Traders immediately push prices up just in case supply gets tight. An expert warned that if the Straits of Hormuz were seriously disrupted, oil prices could even shoot to $100 per barrel in the worst case scenario. That's why the minute news broke of conflict, oil prices went up. It's like hearing a rumor that a popular toy might be out of stocks before the holidays. Everyone rushes to grab what they can, driving the prices up. Now, you might be wondering, Why are Israel and Iran even fighting now? What sparked this? These two have had bad bloods for decades. A little history. Iran's Islamic Revolution in 1979 put a government in power that refuses to recognize Israel as a country. Iran's leader often called for the end of the Israeli state, and Iran has supported groups opposed to Israel. On the flip side, Israel sees Iran as a huge threat, especially because of Iran's nuclear program. For years, Iran has been enriching uranium, which could be used for a bomb, and Israel has sworn it will never let Iran get nuclear weapons. This, the rivalry, often played out in the shadows. Cyber attacks, mysterious explosion at Iranian nuclear sites, proxies fighting like Israel versus Iran-backed groups in places like Syria or Lebanon. But direct clashes were avoided until now.
Breaking news at this hour is calling Israel's declaration of war.
So, what changed in 2025? In short, tensions reached a boiling point over Iran's nuclear advances and a breakdown in diplomacy. Negotiations that involved the US, Iran, and others aimed at containing Iran's nuclear program were stalling and failing. Reports say Iran's uranium enrichment was expanding rapidly, approaching weapons-grade levels, and talks in Oman to defuse the situation fell apart. Israel's government felt time was running out. According to Israeli officials, they decided to launch a preemptive strike, basically a surprise attack to wipe out Iran's nuclear facilities and military sites before Iran could go any further. Late on Friday, 13th of June 2025, Israel struck multiple targets across Iran in a massive air offensive. They hit nuclear centers like Natanz, military bases, and even oil refineries and depots around Tehran. Huge fires lit up in the night sky in Tehran as a fuel depot exploded. Israel's defense minister declared that Iran's missiles and nuclear program must be crippled. In response, Iran didn't back down. They fired hundreds of missiles back at Israel over the next few days. Some Iranian missiles got through Israel's air defenses and hit cities, tragically killing civilians, including children near Tel Aviv. Israel's prime minister went on camera standing by a wrecked apartment building, vowing that Iran will pay a heavy price for the murder of civilians.
Over the Iranian skies, Iran will pay a heavy price for the killings.
Both sides started telling civilians to evacuate areas near potential targets. At one point, Israel even warned hundreds of thousands of people in Tehran to leave certain districts. Iran's military similarly told Israeli to clear out from around vital areas. It was an incredibly intense escalation, something the world has never seen directly between these two nations before. And where is the US in all this? The US is an ally of Israel but also didn't want a full-blown war. Interestingly, US intelligence seemed to know something big was coming. Just 24 hours before the bombing started, the US evacuated non-essential staff from its embassy in Baghdad and put personnel in places like Bahrain and Kuwait on alert. That was a huge sign that Washington anticipated an Iranian retaliation that could threaten Americans in the region. When the strikes happened, the US publicly said it was not involved in Israel's decision and even urged Israel to avoid civilian casualties. But it firmly warned Iran, do not hit US people or bases. President Donald Trump took a very hard line supporting Israel. He even demanded Iran's unconditional surrender at one point, which shows how huge the stakes got. However, behind closed doors, reports say the US did place some limits. For example, US officials vetoed an Israeli plan to assassinate Iran's supreme leader, fearing that would blow the conflict wide open. Instead, the US is beefing up its military presence, sending extra fighter jets to the region as a caution, while also quietly working with allies like Oman and Qatar to see if any ceasefire can be reached. In short, the conflict ignited because of long-standing friction supercharged by recent events, failing nuclear talks, Israeli fear of a nuclear-armed Iran, and an opportunity that Israel's leadership seized to strike. The result? A sudden war that took the world by surprise. But not entirely the US, which had hinted something was up by pulling its people out just in time. all of this feeds back into the oil story we discussed. Once missiles started flying between a major regional power like Iran and the US-backed nation Israel in the oil-rich Middle East, the markets panicked about supply disruption. Hence, oil prices went up. That brings me to the next part. You don't have to navigate this all alone. Everything we have discussed today, from technical analysis to reading news to sharpening your trading mindset, these are skills to learn over years. And one of the best ways to accelerate your learning curve is to learn directly from experienced professional traders who have seen multiple market cycles. That's why I'm excited to announce an upcoming webinar that I'll be hosting in collaboration with a pro trader whom I really respect, Jose Blasco. If you haven't heard of Jose, he's a multi-asset trader with well over a decade of experience in the markets. He started trading around 2008 and, like many of us, went through the school of hard knocks during the global financial crisis, then navigated the long bull market and the wild swings ever since. Whether it's a short-term scalp trade or a long-term position, whether it's an equity or a forex pair, Jose has likely traded it. Beyond just trading, Jose has a passion for teaching and technology. Since 2011, he has been sharing his methods as a trading instructor, appearing in live seminars and online trainings to mentor other people. He even went on to develop innovative trading tools and technology that I've talked about before in my previous videos. These tools aim at helping traders gain an edge. With an engineering background, he brings a very analytical and systematic approach to trading, which I think you'll find incredibly valuable. And he's truly global. He's taught students around the world and is known for being able to explain complex concepts in a clear, practical way. In our upcoming webinar, Jose Blasco will be joining me to pull back the curtain on what it takes to trade successfully in markets like this. We are going to dive into the insights, skills, and tricks that professional traders use to thrive when the S&P 500 is at all-time highs and volatility is swirling. I want this session to directly address the challenges you might be facing and the questions you might be asking yourself. So I warmly invite you to sign up for the webinar with Jose Blasco. The details of the registration are in the description or on our social media platforms. It's happening on the 24th of July. It's a Thursday at 8 p.m. But spots may be limited, so definitely reserve your seat. Whether you're male or female, young or not so young, if you're an intermediate trader or even a motivated beginner who have been following along, I believe this event can be a game changer for you. It's not every day that you get to learn from someone with a proven track record and a genuine passion for teaching others. And it's completely in line with what FAQ Show stands for, bringing you opportunities to learn from experts and elevate your own financial game. Most of all, this webinar is completely free. I hope this discussion has given you not only information but also inspiration to take action. The market will always be changing, throwing new puzzles at us, and that's what makes it fascinating. With the knowledge and strategies we've talked about, you'll be better prepared to solve those puzzles and profit from them. But what about the rest of the global markets? The moment news of the Israel-Iran conflict hit, it wasn't only oil traders who panicked. This became a risk-off moment for many investors worldwide. For stock investors, they don't like surprise wars, especially in important regions. Stocks around the world wobbled and some fell. Why? Because higher oil prices can act like a tax on the economy. It raises the cost for businesses and consumers, potentially slowing growth. For example, airline and travel company stocks tank on the news because jet fuel is basically refined oil and major cost for airlines. If oil stays expensive, airlines either have to eat the cost or charge passengers more. Neither is good for business. True enough, an index of global airline stocks slid sharply once oil jumped and investors realized flights could get pricier and profits get thinner. In general, the conflict added a layer of uncertainty, and markets hate uncertainty. On Wall Street, the major indices initially fell on the headlines. Tech stocks, bank stocks, most sectors saw some declines, with a few exceptions like energy company stocks, which rose because they benefit from higher oil prices. For bond investors, in times of fear, many of them rush to buy more bonds because they are considered as relatively safer investment choice. Buying bonds pushes their yields down, which indeed happened briefly as the conflict escalated. US Treasury yield dipped as money flowed into the safe haven asset. This is a typical pattern. When people worry about geopolitical crisis, they often prefer the safety of fixed income over the volatility of stocks. Central banks also started watching closely. The Fed, for example, had to consider whether a potential oil price-driven inflation bump might complicate their interest rate decisions. As we know, higher oil can increase inflation, which might make central banks hesitate to cut interest rate too soon. It's a tricky balancing act. Ensure stability without choking off an economic recovery. For gold and safe haven currencies, whenever there's fighting or global tension, you often hear that investors flock to safe haven like gold. True enough, gold prices have been strong. In fact, even before this conflict, 2025 was shaping up to a record year for gold prices. This is because of various uncertainties going on. Gold is like a security blanket for investors. It tends to rise when people are nervous about war or inflation. We saw gold inch up as the Israel-Iran clashes escalated. The same goes for currencies like the US dollar. The dollar often strengthens during global crises because many see it as the world's safest currency. There were reports of investors moving into dollars and Japanese yen right after the conflict news, seeking a safe place to park their money. This flight to safety is a classic reaction. Sell riskier assets like stocks and buy things perceived as stable like gold, US dollar, government bonds. One notable stats from a World Bank report. During big geopolitical shocks, gold has often jumped and stayed 150% higher than pre-crisis levels, underscoring how much people lean on shiny metal in uncertain times. Beyond specific assets, there's a broader effect on how investors feel. Sentiment took a hit. Suddenly, talks of global inflation heating up again started swirling, just when we thought we had successfully controlled inflation. For example, if oil stays high, it can fuel inflationary pressures by making everything from shipping to plastics more expensive. Already, we saw headlines inflation forecasts being adjusted upwards in some places after oil jumped. These could mean central banks might keep interest rates higher for longer to combat that, which in turn can weigh on economic growth. It's a chain reaction. Markets are now juggling those concerns. On one hand, slower economy due to war risks. On the other hand, possibly higher inflation. A double whammy. However, it's not all doom and gloom. So far, the actual impact on oil supply is limited. Major oil facilities outside Iran haven't been hit, and the Strait of Hormuz remains open as of now. That's why, after the initial spike, oil prices cooled off a bit when it looked like neither side was targeting oil shipments directly. The global system also has buffers like the strategic oil reserves in the US. For example, the International Energy Agency said it's ready to release emergency oil stockpiles if needed. Over 1 billion barrels are in reserve among major economies. The OPEC, the group of oil-producing nations, urged caution but noted that so far supply is still steady. This reassurance helped calm markets slightly, but everyone remains on watch. Alright, so if you're an investor, what can you do in such wild and volatile times? If you trade oil futures or invest in energy stocks, you're probably already glued to the news. These events are major trading opportunities but also big risk. Prices can swing several dollars per barrel in a single day on a headline or rumor. If you think this conflict will be prolonged, some traders might bet on prices staying high or rising. But be cautious, if there's suddenly a peace deal or a ceasefire, oil could drop just as quickly. And it has happened. As an individual, if you have significant investments that get hurt by high oil prices, say airline stocks or certain manufacturing companies, you could balance that by also investing a bit in oil or energy assets. The key is not to put all your eggs in one basket. Remember this, geopolitical price spikes often don't last forever. If you have made profits from a big run, be mindful of when to take some profit off the table. As the old saying goes, bulls make money, bears make money, but pigs get slaughtered. In other words, don't get too greedy riding the wave. For everyone else, if you're not actively trading but you have a retirement plan or just general interest, what does this conflict mean for you? A big thing is inflation and interest rates. As we noted, higher oil can mean higher inflation, which could affect everything in your daily lives. Maybe you want to start to budget for potential higher bills and expenses in the coming months, just in case oil stays pricey and causes everything else to inflate in price. For investors, consider having a portion of your portfolio in assets that traditionally weather inflation and uncertainty well. Lastly, keep an eye on the news, but don't let it dominate your emotions. Geopolitics can change rapidly. By the time you watch this, the conflict has somewhat subsided with a ceasefire deal between the two countries. Use reputable sources to stay informed, and remember that governments and international organizations are actively managing the situation. Knowing that there are safety nets can help you stay calm. In conclusion, the motto during events like this is stay calm, stay diversified, and think long term. Panicking usually does more harm than good. Instead, use this as a learning moment. Now you have seen how a conflict can ripple through oil, inflation, and markets, and you can adjust your strategies so you are prepared for future uncertainties. Sometimes, that might even mean doing nothing and sticking to your plan, which is perfectly fine if your plan was built with ups and downs in mind. I hope this video leaves you not only better informed but also confident. The tone of the news may be scary, but when you break it down, like how we did just now, it starts to make sense. And when things make sense, we can manage them. Thank you for watching the FAQ show. If you found this explanation helpful, give us a thumbs up and subscribe for more easy to understand insights on big world events. Stay safe, stay savvy, and we'll see you in the next video.